Record.
Now, so we can make the best use of our time, let me kind of start in the middle of the chapter, okay? And work toward the end, and that way I think even it'll just work the best in terms of giving an introduction that'll help you, that'll enable you to start your homework. So here's what you do. Here we have, what we have is we have assets equals liability plus owner's equity. And here we have an account, cash. And here we have sales. So what you do at the end of the day, and let me put up numbers that are easy to see, okay, just for illustration purposes. So at the end of the day, what you do is you count the cash in your drawer. You took it $102 worth of cash. You take out the cash register tape, and it shows that you had $100 worth of sales. So here's the cash register tape, right? And that's revenue. Here's your cash account. What does this mean? Well, it means you took in $2 too much change, right? Now, this is an easy one to fix, because you just take $2 out of the till, put it in your pocket, go home. I'm kidding, you guys, I'm kidding, right? Don't do that. But I try to make it memorable, right? Because you'll remember it now. What you do in this case is you have what's called a cash short and over fund. So what it is here's what the journal entry would look like. So cash will be debited for 102. Sales will be credited for 100. And there's $2 missing. That goes in an account called cash, short, and over. Okay? Cash short and over is an owner's equity account. It's an owner's equity account, and it's used to reconcile it. So what you want is, it's one that can have either a debit or credit balance. In this case, it's a credit balance because you took in too much change. If it has a credit balance, it'll show up on your income statement with the revenue, right? It'll work the same as revenue. Let's say the next day. Now, the next day, you have $97 in cash. You have another $100 sale, right? So this means that you gave out too much change, right? So that will be journalized as a cash. It will have a debit of 97. Sales will have a credit of 100. There's a $3 debit that's needed there. It goes into cash, short, and over. That $3 will show up as a debit here. That gives you a balance of a $1 debit. With this balance, it will now show up as an expense with the other expenses. Okay? So the cash short and over fund, it's a fund that accounts for cash shortages and overages. And of course, if you own a business, you want to keep track of how your salespeople are keeping track of change. Because if they give out too much change, right, you have an expense and probably no benefit. If they consistently shortchange your customers, you lose customers. So what you want is there can be a little bit of error. Nobody's perfect, but you have to decide what's tolerable for your business. Okay. Okay, so cash short and over, it's an owner's equity account. It can have either a debit or credit balance depending on whether there's an overage or a shortage. If it has a credit balance, it'll show up as revenue with the revenue accounts. If it has a credit balance, I was pointing to the wrong place. If it has a debit balance, then it will show up as an expense with the other expenses. Okay? Now, let's get into petty cash. Now what you do is a Girl Scout shows up at your business, at your office, right, trying to sell Girl Scout cookies. What do they cost these days, do you know?
$4 a box.
$4 a box, all right. And you think, listen, I believe in the Girl Scouts, and it's kind of good PR. So what I'll do is I'll pay $4 for this candy, for this cookies. I'll put it right here where everybody sees that I bought these cookies. So when they come in and do business, maybe they'll take one, maybe they won't. Who knows? This thing should last a long time. It's good for PR. No, but I thought it was a joke. Everybody looks, well, yeah, so. Well, I thought that was supposed to be kind of like cynicism, right? I think, but no. All right, never mind. Everybody thinks, good idea, I'll buy 2, and that way I can just keep replacing it. Who knows, maybe I can have this thing out there for, okay, all right.
Everybody loves cookies.
Anyway, here, what's that?
Everybody loves cookies.
Everybody loves cookies, huh?
There it is.
All right, yeah. I was thinking of the PR. All right. Well, here's what happens. You have something called petty cash. And petty cash, what it is it's a small amount of cash kept and somebody in a front desk, like the receptionist, is the custodian for this, so that when somebody comes in, the Girl Scouts selling cookies, or if you get a UPS delivery that needs payment, whatever, this person pays it. So when you establish it, it looks like this, okay? So in this case, you say, listen, it seems to me that I should have $75 in there, right? Okay? So when you put $75 in there, you debit you debit petty cash. For the 75, and you credit cash for the 75. Okay? Now, petty cash is an asset account. So now when you established it, you debit this 75 and you credit cash for 75. So this is what it looks like when you establish. Okay? So what you've done is you set cash aside to pay the bill, to pay these small amounts of bills. So what it is when you established it, you wrote a check to the petty cash custodian, that receptionist who's in the front desk, right? And you wrote him or her a check. They went to the bank, cashed the check, they got some coins, they got some dollar bills, they put those in a locked box, desk drawer, whatever, and what you did is you took the cash and you set the cash aside to pay those small bills that are too small to write a check for. Okay? So that instead of writing the Girl Scout a $4 check, you give her 4 ones. Okay? All right? Now, so here you set the cash aside. Then, throughout the period, people come in, make purchases, and then you replenish it. So this is you establish it. Then what you do now, you replenish. So when you replenish, what happens here is you set the cash aside. Now you're spending this cash, right? So in this case, you have a debit to miscellaneous expense. Of $46.50. Okay. You have a debit to merchandise inventory of $15.05. Now the reason you're debiting merchandise inventory, what this thing was, the UPS guy showed up and says, here's some of your merchandise, right? And the delivery charge for that, the FedEx charge for that is $15.05. Because it's the perpetual inventory, because it's the periodic, what it is that is a debit to the asset inventory, right? Delivery expense, now this will be a sales expense. This will show up as a sales expense because this is freight out. Delivery expense of $5, okay? And office supplies expense of $4.75. Now you add all these up and they equal $71.30. What account, so here's all your debits, you add them up, the credit has to equal $71.30, right? What account do you think gets credited? Well, what did you do now? Jessica, I'll be right with you. What did you do? You set the cash aside to spend and now you spent the cash. Jessica?
Your total isn't right. It's
How do you get to 30 from that?
right.
Listen, this is what the number they gave me, all right. Oh, I see, you guys, here we go. There we go.
think it debit petty cash. Or
No,
credit petty
cash. Okay, you credit cash. And what you're doing here now is you set the cash aside, right? By giving it, so here you get to set the cash aside. And the petty cash custodian spent the cash, and now you're accounting for that spending of cash. Because he or she spent the cash, right? And now you're accounting for that. Candace, how you do with that?
I think I'm doing okay.
All right, and again, you just a quizzical look is the only reason I mentioned it. But again, it's the idea that you spent the cash and now you're accounting for that cash that's been spent. You set it aside here, okay? You set the cash aside, right? Okay, so you set the cash aside, and then here you spent the cash. So now you're saying, okay, that makes sense?
Is your petty cash then always increasing?
It'll never change. Now, what it'll do now is then you, in other words, now what happens in this thing is then you write another check for $71.30, give to the custodian, and it will bring it back up to this total. I'll be right with you, Jessica. So in other words, if you open if you open the box where this is kept, you add up all the receipts, and then you add that to the remaining change. All the total should be $75. Okay, Jessica?
So petty cash, the amount always stays the same.
Exactly.
Like at my work, when we have to pay a vendor or something, we pay them out of the drawer and we have a little paid out slip, and we count that in our total, like at the end of the day, so I guess that would be like petty cash, because we count it, it has to equal the same at the end of our day. And we count those as actual money, even though it's just a piece of paper. Is that the same as the?
Same thing, says, what you do in this case is, you add up all of these receipts, if you will, or they're a voucher, whatever there's going to be some sort of documentation, right? So you add up all the documentation where the money is spent, add that to the remaining cash, and it will equal the balance of the petty cash fund. In this case, the remaining cash plus all of this will equal $75. And if it doesn't, then you have to use the cash short and over fund because there was an error that needs to be reconciled. Okay, that sound good? All right. So, okay, so let's take a look here. So in this case, so again, let's kind of go over. So what do you do now in step one? You establish the petty cash fund and you debit petty cash and credit cash. Both of those are asset accounts. You're setting this cash aside, okay? And then at the end of the accounting period, a month or whatever, you then account for the cash that's been spent. And so what you do is you have all these receipts, right? And then the total of receipts plus the remaining cash should equal, in this case, $75. It'll equal the balance of the petty cash fund. In this case, and if it doesn't, then you have to use what? The cash short and over to reconcile the difference, right? And then, in this case, the cash plus all the receipts did equal 75. So the accounting for this, what it is you add up, so everything here will be a debit. You're either paying an expense or you're buying an asset, okay? They'll all be debits. You're either paying an expense, so here's office supplies, what expense, you're expensing it. But anyway, you're either buying an asset or you're paying an expense. You spend the cash and now you're accounting for that cash. If there's a difference between the total of the receipts plus the remaining money, you need to then use the cash short and over to reconcile that difference. Does that sound good? All right, so let's move this into long-term memory. Do you guys want to do exercise 8-5? You can find that on page 8-5. Find that on page 347. All right, let me turn that camera around. Thank you. And let me put it on the board. Turn on the light so that's readable. Okay. So it's exercise 8.5, page 347. So here it is. All right. Now this will have a shortage, right? So we've got to put in our thinking cap. So what it is, so in this case, here's what happens in this thing. So, all right, so the Hawk Company establishes a $400 petty cash fund, right? On September 30th. The fund shows then, that's on September 9th, so we establish it, right? So we're going to debit petty cash, credit cash. Then, on September 30th, the fund shows 166 in cash along with receipts for the following expenditures. So, what it is you have transportation in, $32, so they bought some merchandise for resale. Postage expense, $113, miscellaneous expense, $87. There's apparently a $2 shortage. So if you add up all the receipts plus the 166, it should equal $398. $2 is missing. Okay, that's the cash short and over fund. They used a perpetual inventory system for merchandise inventory, right? So on September 9th, establish the fund, and the 30th, reimburse the fund, and then decrease the fund to $300. All right, let me turn this over to you guys. Feel free to talk to the person next to you, of course. So you're going to have to use the cash short and over fund for the $2 that's missing, and then you're going to have to change the balance from 400 back to 300. Guys, let me give you some feedback on this. So on September 9th, you established the fund. And so in this case, you're going to debit petty cash.
You're off the.
I'm off the screen. Sure. Let me just kind of change this. So you debit petty cash for the 400. Okay, and you credit cash for the 400. So now what you're doing is you're setting this cash aside Both of these are asset accounts. And so cash goes down, petty cash goes up, you're setting cash aside. Okay? Everybody okay with that? Now, what it is $400 is the balance of the fund. You have 166 in cash left. Therefore, there should be 234 spent. That's what the total of your receipt should equal, right? So what you did is you spent 32, you spent 113, you spent 87, so you spent 232. So here's what you spent, here's what you should have spent. There's a deficit of 2. Okay? What you also could have done is you could have added the 32 plus the 113 plus the 87 plus the 166. And if you do that, you should end up with 398. So what you can do is you can add up the receipts plus the cash, and it should equal the balance of the fund. In this case, it'll be short by $2. You can do either method. All right, so now on September 30th, you're going to replenish it. So merchandise inventory, and I'm going to write INV for inventory to move along, is debited for 32, and that's because it was a freight in. It's the perpetual system. Okay. Postage expense, you bought some stamps or something, is 113. Miscellaneous expense. Now, let me say something about this. As a general rule, try not to have or use a miscellaneous account. And the reason is because at the end of the period, you want to say, could I have done a better job, right? And when you have an account and you don't know what went into it, you can't answer that question. Sometimes you got to, right? But try not to have one, try not to use one, because it doesn't give you good information. Okay, well, these people had one, so we have one. Okay, 87. Now that $2 we're missing will be a debit to cash short and over for $2. And you add all this up, it equals 234, and that's the amount you got to put, that's the amount of cash that you're accounting for. Okay, so you're saying I'm accounting for this cash that's been spent. I spent $234 on all of these items. Okay, plus there's $2 missing. So you're accounting for this cash that was spent. Now, the next one, on October 1st, we want to lessen the amount. And what we'll do is we'll reverse this entry. So now cash will be debited for $100, and petty cash will be credited for $100. I'm going to put up a printed copy, so it's give you the best feedback. Okay, and these are just notes to myself to remind me to say things. So what's really important to remember is that the only time the petty cash account is used is when you establish it, when you change the amount, or if you decided to discontinue. When you replenish it, you credit cash. What you're doing is you're accounting for the cash that you spent. You spent this cash, and here's where it went. And then the total of the receipts plus the remaining cash should equal the balance of the account. If it doesn't, then you need to adjust with cash short and over. All right, you guys doing, are there any questions on that? All right, you guys are doing good. Let's do this. Should we take our 10-minute break? And we'll finish chapter 8. We'll make a dent in chapter 8. Maybe we get it wrong.
Do you want to stop the recording?
Oh, yeah, thank you. No, I appreciate that, yeah.